Here's a mistake I see business owners make all the time. They need funding, so they Google business loan, click the first result, then they gather documents, submit everything, and either get denied, their phone starts blowing up, or they get served with this short-term, high-interest option. And then they come to me and say, Zach, why did this happen? The answer is almost always the same. They applied to the wrong lender for them. Not because they had bad credit, not because their business wasn't strong enough, because every lender has a lane, or what we call in the lending industry, a credit box. And if you're not in their lane or their credit box, it doesn't matter how good your application is. They're just not going to say yes. In this video, I'm breaking down the 5 types of business lenders, who each one is built for, what they actually offer, and how to figure out which one fits where you are right now. This is a video I wish somebody had handed me when I started in this industry, because knowing this one thing can save you weeks of wasted time and multiple hard credit pulls. Let's get into it. The setup. Before I walk you through each lender, I want to give you one principle that ties this whole video together. The best lender for your business is not the most recognizable one. It's the one who understands your specific situation. Banks are built for stability. Fintech lenders are built for speed. Non-bank lenders are built for growth. Alternative lenders are built for access. Each one has a different tolerance for risk, a different speed of decision, and a different profile of a borrower they actually want to work with. Your job as a business owner is to match yourself to the right one, not chase whoever advertises the most. I've helped over 1,000 businesses get funded by matching them to the right lenders for them. And the single fastest path to a yes is walking through the right door the first time. So let me show you those doors. First up, traditional banks. Think your Wells Fargos, Bank of America, your local community bank. These are the lenders most people think of first. And honestly, they should be your first choice if you qualify. Because when you do qualify, banks offer the best terms in the business, the lowest interest rates, and the longest repayment periods. The catch? Banks are very, very slow and extremely selective about who they lend to. They want to see at least 2 years of consistently increasing profitable history, strong personal and business credit, collateral ideally, and extensive documentation. For established businesses with clean books, 8 figures a year plus in revenue, a bank is the goal. But if you're newer, growing fast, or had a rough year, the bank is probably not your door right now. And that's not a failure, that's just information. The other thing I'll say about banks and conventional lenders, the relationship matters more than people realize. If you have a banker who knows you, who's watched your deposits grow over the years, that banker will likely go to bat for you in underwriting in a way that no algorithm can replicate. Build that relationship before you need it. Option 2, credit unions. Credit unions are essentially member-owned banks. They're smaller, more personal, and often more flexible than traditional banks and conventional lenders. The rates are typically competitive, sometimes better than the large banks, and the service tends to be more relationship-driven. The limitation with credit unions is scale. Credit unions often can't go as high on loan amounts as big banks can, and you need to be a member, which means you need to already have an account there or qualify for membership based on location, employer, or industry. If you're a member of a credit union or you're eligible to join one, it's worth having a conversation with them, especially for businesses in specific industries. Some credit unions specialize in certain sectors and have real familiarity with how those businesses in those industries operate. That familiarity translates directly into better underwriting decisions. Option 3, online lenders. Online lenders changed everything after the financial crisis in 2008. When the big banks tightened their lending standards, fintech companies looked at the same problem from a completely different angle. Instead of requiring all 3 of what I call the 3 C's, credit, collateral, and cash flow, they built models that could work with just one. If your cash flow is strong, but your credit is average, online lenders and alternative lenders can work with that. If you're under 2 years time in business, online lenders often do not have have the same restrictions. The trade-off is cost and terms. You pay a premium for the flexibility. Online lenders typically charge higher interest rates and often shorter repayment windows. We're usually talking 3 to 36 months. They move fast, sometimes funding within as little as 24 hours. But you pay a premium for that speed. And I don't want that to scare you. Okay, if you're going to pay 20% for a premium for speed, but you're going to make 50% margin on the use of funds, that is still 30% profit. So here's the thing I want you to hear carefully. Not all online lenders are the same. Some are legitimate, regulated institutions doing genuinely good work for small businesses. Others have very aggressive practices that can trap you in unfavorable terms. Working with an advisor who knows which is which can save you from a deal that looks good on the surface and costs you badly in the long run. This is one of the primary reasons that Small Biz Heroes exists. Option 4, non-bank lenders. Non-bank lenders are the category most business owners don't know about, and it's the one I think is the most underutilized. Small Biz Heroes has tons of these lenders on platform. These are financial institutions that don't take deposits, but specialize entirely in lending. They sit between traditional banks and online lenders in terms of flexibility and cost. What makes non-bank lenders interesting to me is their depth. Many of them specialize in specific industries and programs: trucking, healthcare, manufacturing, restaurants. They understand your business model depending on what industry you're in and what non-bank lender we're using, in a way that a generalist bank simply wouldn't understand. And some of them are actually SBA preferred lenders as well, meaning they can process SBA-backed loans faster than you'd get through a traditional bank. If your business is growing beyond the startup stage, but you're not quite bank ready yet, strong revenue, solid cash flow, but maybe your credit profile isn't perfect, or good credit, but maybe, you had one bad quarter profitability wise. A non-bank lender is often the perfect bridge. You get more favorable terms than an online lender and more flexibility than a bank. And as you build your track record with them, it positions you for a bank relationship down the road. Option 5, alternative lenders. Alternative lending is a broad category that includes merchant cash advances, invoice factoring, 0% APR, business credit card stacking, equipment financing specialists, and private money lenders. These tools exist to solve specific problems. And when you match them to the right problem, they're actually extremely powerful. Merchant cash advances give you fast access to capital based on your future revenue, not your credit. And it also gives you flexible repayment terms as well. Invoice factoring converts your outstanding receivables into immediate cash if you qualify, or more accurately, if your customers qualify. 0% APR credit lines let you access interest-free capital if your credit is strong. Each one is built for a different scenario. The caution that you need to take with alternative lenders is that their pricing is higher and the terms can be complex. An MCA, or merchant cash advance, for example, uses a factor rate instead of an interest rate. And if you don't understand the difference, you can underestimate what it is that you're actually paying. I've done a full video on MCAs specifically because there's so much confusion around them, and I'll link that video below. Alternative lenders are not a last resort. They're a different tool in your toolkit. The key is using them intentionally for the right purpose, with a clear plan to move into more affordable financing once you've built the profile to qualify for the more affordable financing. But just because you're building, that shouldn't stop you from borrowing. The framework, how to choose what's best. So, how do you actually decide which lender is right for you? Here's how I think about it and how I walk through it with every client at Small Biz Heroes. First, where are you on your journey? If you've been in business less than 2 years, your universe is smaller, but it's not empty. Online lenders, alternative tools, 0% credit lines, and some non-bank lenders all work in this zone. Second, what does your credit look like? Above 650, the door's open to SBA loans, term loans, lines of credit. Below a 650, you're starting with revenue-based or asset-based options, and you're building towards those better tools over time. Third, how quickly do you need the money? Banks take time. sometimes 60 to 90 days. Online lenders can move in 24 hours. If the opportunity is time sensitive, that changes the calculus. And fourth, what's the purpose of the capital? Your use of funds. Equipment financing, for example, works best with equipment collateral. So you're automatically looking at non-bank or alternative lenders who specialize in that. Credit unions and conventional lenders also can do equipment financing as well as dealerships, but they're harder to qualify for. Invoice factoring only makes sense if you have outstanding B2B invoices or business to government invoices. You need to match the tool, the program, to the job, the use of funds. Here's the bottom line. There is no universally best lender or universally best rate. There is only one right lender for your specific situation right now. And that situation changes as your business grows, your credit improves, and your track record builds. The goal is always to move towards better, cheaper capital over time. And every step forward is a win. I actually cover all of this in detail in my book, The Hero's Journey to Capital. There's a full chapter on lender types, what they're looking for, and how to match yourself to the right one at every stage of your business. If you want the complete framework, not just the 5-minute version, the book is available now, and I'll put the link in the description. If you're trying to figure out which lender is the right fit for your business right now, that is exactly what we do at Small Biz Heroes. We review your situation right now, match you with lenders who are actually a good fit, and negotiate on your behalf so that you get the best deal, and you're not wasting time on doors that were never going to open for you in the first place. You can hear more about what fits your funding situation best at the link in the description. And if this video helped you, hit subscribe. I put out new content every week on business funding, credit strategy, and how to get the capital your business actually deserves. I'll see you on the next one.